It's been a while since I've taken the time to make a video that just addresses a bunch of questions. And I've been getting a lot of juicy questions around investing and taxes on the channel. And every now and then, I think it's a good idea to share some of those questions with you guys and some of my responses, because I think a lot of the people have the same question or similar questions. And so that's what we're gonna do in this video. Chipper, cue the intro. My name is Mike the CPA and welcome to Money and Life TV. Now I'll be giving my responses to all these different questions, but guys, it's so much more fun. I think we get so much more out of it as a community if you guys dive into the conversation as well. I would love to hear your thoughts, your opinions around these questions. I'm simply giving my outlook based on my experience as a CPA and as an investor. I'm gonna go over these rapid fire. Let's start off with some easy ones. One of the most common questions I get all the time and all year long is, are my reinvested dividends taxable? Yes, as long as those investments are in a taxable account.
Where's all your money gone, Donnie?
Taxes.
The second most common question I get on the channel is about losing money. And losing money sucks. I mean, it kind of feels like this. But it's not all bad news, because when you lose money in the stock market in a taxable account, if you file single for your taxes, or if you filed married filing joint, you can offset other forms of income by as much as $3,000 max. And don't worry, if you lost more than that, which I hope you didn't, but if you did, you can actually roll that money forward into future years, and those losses can offset future gains, whether they're short-term gains or long-term gains, in a different taxable year. All of you out there you're striving, you're working to improve your financial position, and one of the most common questions I also get deals with emergency funds. And not the emergency like a medical emergency, but just any kind of emergency, financial emergency you may have. And so the question I get is not should I have an emergency fund, but where should I put where should I put that money, or what should I put it in? And I've had a few people recently ask me, hey, should I put money in a Roth IRA for an emergency, or a traditional IRA? So what I recommend is keeping those emergency funds outside of those accounts. Keep it in a savings account. Some of you asked, should I put it in a CD? And I usually don't. I would rather see you, if you want to put it in something other than cash, like a checking account or savings account, I would put it into like a money market fund. You might consider a short-term bond, or, one person asked, should I put it in tax-exempt bonds? You can, but the problem with bonds is they can fluctuate in value, whereas if you just have the money sitting in cash, yes, that money is losing to inflation, we know this, but at least the value of that money is not fluctuating like an ETF. Bottom line is, if you want to have an emergency fund, I recommend either keeping it in a savings account, checking account, or within a taxable brokerage account, so you can access the money anytime in case you actually have an emergency. Oh, who am I kidding? We all know we're gonna take our emergency funds this year and spend it on Baby Yoda merchandise. Isn't he so cute?
This is the way. This is the way.
The next question we have here is a very common one from the tax perspective, is dealing with gift taxes. I get this all the time, especially at my day job as a CPA. Just so you guys know, if you ever receive a gift, whether it's property, ownership in a business, like cash or whatever it may be, whatever that gift is, it's not taxable to you because it's a gift. The person who pays gift taxes is the person who donates the gift. In reality, that's going to be a very rare circumstance though. Even if you're giving away a lot of cash, assets, whatever, the lifetime exemptions for estate and gift taxes are so high, most people can give money freely without ever running into really any real issues, unless they're part of like the 1% and they're trying to donate a fortune, like hundreds of thousands or even millions upon millions of dollars, which is very rare, very infrequent. The next question I have really deals with making a lot of income from dividends while paying no taxes at the same time. Many people don't know that qualified dividends, when you receive them, they're taxed at lower rates. And I've mentioned this now in many of my other videos. The example I gave in the last video I produced, the video that talks about what investments are best suited for each type of account, I mentioned in that video that a person could make $100,000 in dividends and pay zero in taxes.
Right on! Let's do it! Rock that world! Rock that world!
Now, why is that, or how is that even possible? For a married couple, if in 2020, if they're making $100,000, let's say, and let's just say all their dividends are qualified, which means they get the special capital gain rate tax treatment. The first $80,000 of dividends, of those $100,000 in dividends, is taxed at 0%. So $80,000 of the 100 is taxed at 0. Well, that means we have $20,000 left that is subject to tax. Well, the remaining $20,000 in dividends is that any tax on that is completely offset by a person's standard deduction, which is $24,000. So in theory, you can make $104,000 in qualified dividends and still pay 0 in tax because of the capital gain rates exclusion on the first $80,000 in dividends if you're married, and the standard deduction of $24,000.
Damn!
Because it's towards the end of 2019 and there is a new W-4 coming out next year, I'm starting to get a lot of questions regarding how to fill out the new W-4. Well, don't worry, I have a video coming probably sometime in January of how to walk through that process. So just hold those questions, hold those thoughts, and I'm gonna be working on putting a video together for that. While I'm making these investing videos, especially the dividend investing ones, I get a lot of questions asking why are dividends such a big deal? I mean, why not just, if the stock goes up in value 5%, why not just sell it after 5%? Because with the idea behind their question, their idea behind that thought process is, well, when the company pays out that dividend, their stock prices is just going to fall anyways. So if it basically goes up 5% when they pay out that 5% dividend, this person is saying the stock value is going to fall 5% at that point. So why not just sell when it's at 5% and just not wait for the dividend? Now, to me, dividends are a big deal because it is a form of passive income that is taxed at a lower rate, with the main idea being is it prevents me from doing more work. That money is money coming into my bank account that I do not have to work for anymore. And so that's why it's a big deal. But more importantly, if I think of it from a farming operation standpoint, there's different kinds of farmers. So let's take a chicken rancher, okay? So a chicken rancher, he can do two things. He or she can do one of two things. One, they can sell the chickens off to have them slaughtered and sell the meat, right? They can do that. Or they can sell eggs. Well, I kind of think of dividends like the chicken rancher who likes to sell the eggs. If I take an investment and I sell it after 5%, that asset is now gone. I've just killed it off. Kind of like the farmer who sells this chicken off, for meat. They sell off their chickens. They've gotten rid of that chicken. As a dividend investor, though, I know this is a silly example talking about chickens here, I get it. But as a dividend investor, my concern is the eggs. Because that chicken, now I get to keep the chicken in that example, and I still get the egg. And every year, I get to keep the chicken, and I get more and more eggs. And the more and more chickens I have, the faster those eggs are gonna grow, and I can make money from those eggs, right? So I know that's a horrible way to explain it, but basically, it's not just getting 5% once, but I'm getting 5% every year. And I never have to worry about that again, as long as I've invested in a good company.
I have spoken.
Continuing to talk about dividends, there are a lot of viewers out there who really question that method or strategy. Oftentimes they'll go as far as calling me stupid for wanting to invest in dividends, because they're saying, well, yeah, you can go after that 3%, 4%, 5% yield, but when the stock tanks in value, is that going to outweigh all of your benefits of investing for dividends? And, you're going to basically lose all your money trying to invest in something that pays a dividend. Well, I get where they're coming from, because that can happen. That can certainly happen, and you have to watch out for that as an investor. Your stocks or your ETFs or mutual funds or whatever you're investing in for dividends, it's going to fluctuate in value. Absolutely, it's going to happen. But you want to, if you're picking good companies, and not only picking good companies, but more importantly, you're learning how to manage your risk, so you're not risking too much capital every time you invest, and you're paying enough attention to that company to where if you did need to sell off, you could, then you're going to be fine, in my opinion. Now, I've had stocks or REITs or whatever it may be that have fallen in value at times, and I've held on. And as long as the company, what I found, as long as the company I was invested in had good fundamentals. It came back. And not only did it come back, is I collected dividend income the entire way through. There was a time where I was down a significant amount of money on Chevron, but I didn't freak out. I said, well, Chevron financially, I think they're going to be okay. They're one of the leaders in their industry, if not the leader other than ExxonMobil. And I had a feeling that oil was going to come back, and it did. It did. And when oil came back, the stock price came back with it. And all that whole time, I had made a substantial amount in dividends on that particular investment. Another example was the Blackstone Group, which is a publicly traded partnership. That investment for me this year has got, I didn't buy more shares of it, but that investment this year alone has gone up, I think, about 80%. And so at one point, I was at a huge loss in that particular position. But I held on because I looked at the fundamentals. I saw what they were doing. I saw they were buying up real estate across the country and other commercial real estate. I said, I think they're going to do okay because everybody seems to be buying real estate. And hey, guess what? The Fed keeps lowering the interest rate. And by God, they're doing quite well. And now I went from probably like a 40% loss from a few years ago. Now I'm sitting at a 30% gain. And I've made a very good amount of money and just in dividends, just by sitting and collecting it. And you have to remember though, guys, every time we buy something, most things we buy, they lose value. Like if I go buy, if I go buy this mouse at the store, the second I walk out of the store, what happens? It loses value. Most things we buy loses value immediately. Look at our cars. But we get all freaked out if our stock fluctuates a little bit in value. Prices are gonna fluctuate. You just have to get comfortable with it and know what to do if things go south. We have another tax question here is basically how does somebody verify your mileage if you were ever audited? Well, the way they do that is with mileage logs. You can use apps on your phone that can spit out records for you if need be. But the simplest way to do it, or one of the other ways to do it, is just have pen and paper, track your mileage, and do a brief description. And by brief description, I just mean write a sentence or two about where you're going and why you were driving to that location for your business. And that's basically all you need. You just need your date you travel, the reason for why you're traveling, and the total miles you drove for business. That's pretty much it.
And if you're horrible at keeping mileage logs, don't worry. Just ask your controlling spouse, as I'm sure they've been keeping track of your movements all day long.
This next question I don't get a lot, but I think people should really hear the answer on this, and it deals with inheritance.
And two, we need to talk about who's gonna get my rental property.
When you die? Mama, are you sick?
Do I look sick?
This person, they reached out, unfortunately their grandmother passed away, and when their grandmother passed away, apparently she had a taxable account, or at least that's what I'm assuming from her question. She inherited those investments. Now she needs the money, so she's thinking about selling off some of those investments. So how is that going to work from a tax standpoint? Luckily, the answer is very simple, but you kind of have to know the rules around that. So if somebody has a taxable account, and let's just say they own Apple stock, and let's say your grandmother, let's say it's your grandmother, that's who you inherited the stock from. Let's say your grandmother bought Apple for $50. She bought it way back when. Now Apple is at $200 something, right? Let's just say 200. So when grandma passes away, and let's say she dies on July 1st of 2020, July 1st of 2020. And let's say on July 1st, Apple's now worth $300 a share. And you know that once grandma dies, she's a very sweet, loving grandmother. She's going to pass that stock along to you. Well, at the date of her death, whatever the value was of that Apple stock is what your cost basis is going to be for taxes. So grandma dies on July 1st. Her Apple stock was worth $300 at that point. Now you inherit that stock. Your cost basis for taxes is now $300 because that's the stepped up value at date of death. If that did not occur, if grandma had gifted you those stocks, instead of you inheriting them, you would have only got her basis of $50, which is not good for taxes, right? Because you want that basis to be very high. Because when you sell off that investment, you don't want to pay any tax. So grandma dies at July 1st, stock's worth $300, you inherit it, your basis is $300, you sell off that investment the next day at 300, you pay no tax because 300 minus 300 is zero. Now, if you inherited an IRA or a Roth IRA, then it's gonna be a little bit different. But that's how it works though, from an inherited standpoint with a taxable account. The next question comes from Minds in Motion, and I really appreciate you asking this. I think it's a great question, and it's one we could go into a lot further detail in maybe a different video. But I will just say this. The way I determine which account to invest in, whether it's a traditional IRA or a Roth, is to try to figure out where I'm gonna be in retirement. I think that's the biggest factor, or one of the biggest factors that comes into play in this decision. If I think taxes are going to be higher in the future, and if I think my income is going to continue to go up, then I would much rather have a Roth IRA, and that's me. So I hope when I retire, I hope my income is higher, and I think taxes are going to be higher in the future, which is why I choose to invest in a Roth. Now, if I think my taxes are going to be lower in the future, and because I can live off like Social Security, tax-exempt interest, or other things where I think my overall income will be less than I'm making now, then a traditional IRA might make more sense because I can get the tax deduction right now in the present, and when I take the money out in the future, hopefully my overall income is not that high, and I can still take advantage of the lower rates, like the 0% bracket, 10%, 12%, etc. Now the good news is you can, let's say you get going down that path in your traditional IRA, and you figure out, oh shoot, I really want a Roth. Great news is, guys, you can switch it up. You can pause investing in the traditional IRA and then start investing in the Roth. Or vice versa. You can always switch it up at any point you want if you feel, take a look at where you're at, what's going on right now in your life, and determine what the best move is. You're not stuck in one account or the other, but just know that you can only contribute each year to those investment accounts. In total, you can pick one or the other, or in total, $6,000 per year if you're under the age of 50, or $7,000 per year if you're over the age of 50, and that's per person, assuming you qualify to be able to utilize one of those retirement accounts. And Jessen asks, what is my favorite bond ETF? I have two really, maybe three, but one of my favorite ones that I've owned for a long time now is EDV, and that is a long-term Treasury bond fund index, and it's by Vanguard. It tracks the U.S. Treasuries, and it's a very stable. It can fluctuate at times in value, but it's very stable in terms of helping me hedge the market a little bit. Usually when the market goes down, that usually stays steady or goes up a little bit in value and pays me just over 2% every year. My other favorite bond fund is another Vanguard one I like to use. It's an ETF, and I think, my memory serves me correctly, it's VCSH, I think is a ticker symbol, and it's a short-term bond fund. Now, the reason I like that short-term bond fund is not because it pays me a massive amount of interest, I wish, but it's because it pays me, one, it does pay me a little bit of money every month, but more importantly, it's a nice hedge. And so it's usually able to maintain its value. And so when the market has days where it's going up and down or all over the place, that thing is just staying steady. And every month I get a payment from it. And it has proven through history, and this is not guaranteed, but if the market drops in value, I expect that short-term bond fund to hold its value. And it might go down a little bit, but it's not going to go down as nearly as much as my other investments. And, based on history and based on how these things operate. With that in mind, I could then sell off that bond fund, take all that cash, and then buy investments at a lower price. The last question I want to address has to do with retirement, and it is a fantastic, very well thought out question, and I think one we should explore in a future video to go more in depth. But I'll say this. So this person, they have an HSA, they have a Roth IRA, and they have a 401k. Now the 401k, we know that when we take money out, that money is going to come out taxable. Assuming it's not a Roth 401k. So we're just saying it's a traditional 401k. That money comes out, we're going to have to pay taxes on that money. So if we have these other accounts though, what's the best way to do that? Well, let's start with the HSA. First off, the HSA, really, you just want to only use that for medical expenses. I wouldn't want you using that for any other purpose. There might be some exceptions when it comes to utilizing it after you're 65 that I might not know about at this point in time, but usually the HSA, you don't have to think about that too much, where it's strictly just used for medical funds or medical expenses. Where if you use it for anything else, you're probably going to take a tax hit or be penalized for that because it's not a qualified distribution. So let's talk about the 401k and the Roth IRA. Now we know that distributions from a Roth IRA, they come out tax-free, and boy does tax-free feel good.
Yeah, baby. Yeah.
But here's the thing with the 401k, there's a lot of strategy you can implement behind this. Now a lot of people aren't going to want to hear what I'm about to say in terms of a strategy, but this is what works from a tax perspective. This is from a tax perspective. If you want to minimize your taxes on your 401k, then what I would do is this. First of all, I wouldn't want to start withdrawing that money until I've stopped working, or I'm maybe working part-time. I want my income to be as low as possible during that same year when I start to take money out of that account, so that I'm maximizing the lower tax rates. Now, a lot of this though, it really deals with, can you afford to do that? And you have to think about getting yourself set up financially first, and that means paying off all your debts so you can live off the least amount possible and avoid taxes or minimize taxes. So that's the first step, is really paying off all your debt, in my opinion. Then the next thing though is that most people aren't willing to do this, but it works, it's effective. And let me explain why. Is most people aren't willing to delay their Social Security. Most viewers I speak to are just in reading other people's comments when I go to a video on Social Security, they want to take it out at 62. I get it. People want to retire as fast as they can. I understand that. But if you're trying to minimize taxes on all of your investments and think big picture, then you would want to delay taking your Social Security benefits from a tax perspective, whether until you're at least full retirement age or until you're closer to age 70. You don't have to wait till 70 if you want to, I don't care. But at least until you're closer to full retirement age, because once you start receiving Social Security income, that's going to bump up your overall income. So if you were also taking money from your 401k, that's going to make that even more subject to tax. By starting to withdraw from your 401k early after you've quit your job, saving that Roth IRA money or reinvesting those dividends in your Roth to keep generating more and more future income, well, your overall income is going to be super low. And you're likely going to minimize all taxes on your 401k, or most of them. And so that's the way I would probably go about it, and I'll explore these things in a future video more in detail. But you just have to strategically plan it out if it's feasible for you to do so. And you have to think through of when you want to retire, and you have to make sacrifices in order to do this, because a lot of people don't want to wait to take their Social Security. The other thing about taking your Social Security early is if you have other forms of income, it's going to make more of your Social Security subject to tax. So there's all these strategies that come into play, but it requires patience and discipline in order to execute it effectively. So I hope that makes sense. I hope that helps. Now with your Roth, once you turn 59 and a half, you can start withdrawing that money anytime. It really doesn't matter. It's not going to raise your taxes per se, but if you can hold off from pulling that money out of your Roth and keep reinvesting those dividends, then that money is going to grow more and more and more. And by starting to withdraw from your 401k, you're going to minimize your tax hit. You're going to minimize your future required minimum distributions. So in total, you'll be able to receive that money, but pay less tax the entire way through. All right, well, that's the video today, guys. And I just want to say thank you for all these questions. I really appreciate you asking them. And more importantly, I would love to hear you weigh in the comments below. Let me join in the discussion. Let me know your thoughts on what the topics we discussed and your opinions. I would love to hear them, and I'm sure other people would love to hear them as well. If you guys want to support the work I do on this channel, you can do so simply by dropping a like. Like I said, you can leave comments, you can share this video with others. If you've not already subscribed, make sure to do so by hitting that red subscribe button down below. If you hit that little bell notification icon, it's going to notify you every time we release new content on the channel, which is about once per week. All right, guys. Well, thank you so much for hanging out with me today. It's always a pleasure to be here, and I'm honored to have you as an audience. I will see you guys in the next episode. Until then, live life uncaged and take it easy. Peace.